Good afternoon, everyone, and welcome to the Law, Politics, and Media lecture series. My name is Keith Bybee, and I direct the Institute for the Study of Judiciary, Politics, and the Media, which co-sponsors this lecture series, along with the Tully Free Speech Center, directed by this man here to my right, my rock, my lodestar. And on this rock I will build my church, Roy Gutterman. We bring in a series of speakers every spring semester who talk about issues that are under the broad umbrella of law, politics, and the media. And today we are fortunate to have Professor Len Burman. It's really no exaggeration to say that Professor Burman is one of the leading experts on tax and tax policy in the United States. He is the Daniel Patrick Moynihan Professor of Public Affairs at the Maxwell School here at Syracuse University. He is also an affiliated scholar at the Urban Institute and research associate at the National Bureau of Economic Research and senior research associate at Syracuse University's Center for Policy Research. Prior to coming to Syracuse, he was director and co-founder of the Tax Policy Center, which is a joint project of the Urban Institute and the Brookings Institution. He's held high-level positions in both the executive and legislative branches of the federal government, served as Deputy Assistant Secretary for Tax Analysis, the Treasury, and as Senior Analyst for the Congressional Budget Office. And last year he was President of the National Tax Association. Now you might think, well, gee, that's about it. What else could one do? There's no room for even sleeping, given what I've described. But he's also a widely published scholar. He's author of The Labyrinth of Capital Gains Tax Policy, a guide for the perplexed. I think that would include all of us. He is a co-editor of Taxing Capital Income and Using Taxes to Reform Health Insurance. He has written numerous articles, studies, and reports. Today he is going to give a lecture entitled Tax Expenditures, the Size and Efficiency of Government, and Implications for Budget Reform. As is our practice, Professor Burman will speak for about 30, maybe 40 minutes. Then we'll have question and answer with the audience. And at 5 o'clock, we will have a reception right here in this room, which will be an opportunity to continue conversation about the subject and with our distinguished speaker. Please join me in welcoming Professor Len Burman.
Thank you very much, Keith, for that incredibly kind introduction. I thought you were going to say that the real accomplishment was that I have a grandchild, which was born 2 months ago. Oh. And that is really awesome.
Fantastic.
Yeah, it's actually like all the benefits of being a parent with none of the responsibility. I love it. And also when I look in the mirror, I used to say, well, who's this old guy looking back at me? And I said, well, for a grandfather, I don't look too bad. A preoccupation for tax people in Washington is basically how the tax code gets so messed up. I'm actually going to testify tomorrow on tax reform, and tax reform inevitably involves trying to get rid of loopholes, preferences, deductions, all of the things that make the tax code kind of incomprehensible. If you're studying tax law, it makes it really interesting and potentially lucrative. But generally, a lot of these things probably aren't worth their cost. And with my co-author Marvin Falp of George Washington University, we're trying to get a sense of what do tax expenditures do to the legislative process? Why do there seem to be so many of them? Why do they seem to be growing like kudzu? You can tell I lived in the South, and possibly what could be done about it. So that's what this paper's about. The basic premise of the paper is that the budget process is biased in favor of tax expenditures. You know, there has been this debate in Washington about sort of spending versus taxes, and I was actually on a panel probably 10 years ago with Martin Feldstein, who's one of the most prominent conservative thinkers about tax policy in the country. He was chairman of the Council of Economic Advisors for Ronald Reagan. And I made the conjecture that one of the reasons why we had so many tax expenditures was because it was the ideal liberal conservative compromise. Conservatives like smaller government and lower taxes. Liberals like more government services, So the obvious compromise is to make new government services look like tax cuts in smaller government, and that's what they do. So tax cuts are good, spending is bad, so therefore you make your tax spending look like tax cuts, and voila. The theory behind this paper is that voters don't perceive the full cost of tax expenditures because they look like tax cuts. They don't count if you add a $100 billion new tax expenditure, it doesn't make government look bigger by $100 billion. And in fact, it makes it look like your tax bill has been cut. So win-win, unless you think about paying the money back. The result of this, I use the term fiscal illusion. This comes from the political science literature. This misperception about how the government's spending its money is that government's bigger and less efficient than it would be if voters were fully informed. That public good allocation is distorted in favor of tax expenditures. There's too much spending on tax expenditures, including some that are probably not worth their cost, and probably too little on other direct spending programs. And under plausible circumstances, even cash, and this is the most surprising result we found, was that because of this distortion, it might be that even cash outlays, the things we traditionally think of as spending, might be bigger than they would be if people properly treated tax expenditures as spending. So bottom line is that if you treated tax expenditures the same as other spending, then you could improve the efficiency of government. The definition of tax expenditures comes from a prominent tax lawyer, Stanley Surrey, who was the Assistant Secretary for Tax Policy at the Treasury Department in the Johnson administration. And he said that the income tax is composed of two distinct elements. One is structural provisions necessary to implement a normal income tax. Definition of income. What are the rate brackets? What are the basic exemptions? A personal exemption you get for yourself and your spouse and your children, maybe a standard deduction. Beyond that, there are a bunch of provisions found in every income tax that are intended to favor a particular industry, activity, or class of persons. That the Surrey called these things government spending for favored activities or groups affected through the tax system. The concept has actually been around for a long time. Neil Brooks, a Canadian tax lawyer, cites David Gladstone, who was the Chancellor of the Exchequer in the UK in 1867, and the UK had an income tax back then. And they decided that allowing people to deduct money they paid, they contributed to charity would be a good idea. And Gladstone had this radical proposal. He said, we should see how much revenue is lost because of this unlimited charitable deduction, and perhaps we should compare it with other ways we could spend government resources. And this just incensed the opposition. There's a guy, I had this all set up so it could be on the screen, but the technology has escaped us. In the paper, I actually mentions there was one of the opposition politicians was named Lord Stafford Northcote or something like Stafford Northcote. And he said, the right honorable gentleman put it as if to take 5 pounds out of the pocket of a man with 100 pounds is to make him a gift of 95 pounds. So the basic critique was that the whole concept of tax expenditure, it wasn't called that, but what Gladstone was proposing basically assumed that the government owned all your money unless they let you keep some of it. And this is the a lot of conservatives buy the concept of tax expenditures, but the ones who don't like the idea very much, this is one of their key talking points, is that it basically assumes that letting you keep your money is an expenditure, when in fact letting you keep your money is what the government should do, and they should do more of it. The Treasury first estimated tax expenditures in 1967 when Stanley Surrey was Assistant Secretary. The Congressional Budget Act of 1974 mandated tax expenditure tabulation and display in the budget, and many other countries followed suit. Canada, the UK, many other OECD countries followed suit. Actually, Germany had something like this that was in the law even before 1967. They didn't call it tax expenditure. They called it some like 17-word word. I don't speak German, but I know that it must be, money the government takes out of your pocket and gives back to you in the form of a spending program, which sounds awesome in German. So, and actually in a lot of countries, their tax expenditures analysis is much more integrated into the budget than it is in the United States. In the U.S., the budget of the United States has a supplemental volume called Analytical Perspectives. It's wonderful if you need a sleep aid. And Chapter 17, I think, of the Analytical Perspectives has a list of all the tax expenditures. Joint Committee on Taxation, which does revenue estimates for the Congress, puts out a similar volume every year. So what's the thing about tax expenditures? Well, like direct spending, they result in larger government and higher taxes or bigger deficits. They have a similar effect on resource allocation. Princeton economist David Bradford, who actually was an appointee in the Ford administration, and liked to make the point this way. He said, suppose we decided we wanted to cut Pentagon spending, but we actually didn't want to cut the resources available to the Pentagon. We could create a weapons supply tax credit. And a weapons supply tax credit would give you, $1 for every dollar you spend giving missiles to the Pentagon. Well, that might not work. So maybe it'll give you $1.01 for every dollar worth of missiles you give to the Pentagon. So a bunch of rich people who wanted tax breaks would, $10 million worth of missiles, they'd get $10 million plus $10,000 in tax cuts, and they'd be happy. The Pentagon would have what they wanted. And it would be exactly the same thing as giving $10 million to the Pentagon for the missiles, except it would be really stupid, and it will be run through the tax code, and it will be called a tax cut instead of a spending program. Now, that might sound like a really contrived example, but there actually are lots of programs. I guess that I have an example in the article where the veil was actually lifted, but just for a year. The low-income housing tax credit, which I worked on when I was at the Treasury Department in the mid-1980s on staff, was designed to mimic a traditional new construction and rehabilitation program that would be run by the Department of Housing and Urban Development, except we didn't want to give $3 billion to the Department of Housing and Urban Development because that makes you a big spending liberal Democrat. Instead, we gave $3 billion in tax credits, which could be allocated by state housing agencies to programs that met certain criteria, and then the credits could be paid out over a number of years. Pretty much the same way the payments were made by HUD. The only problem is that nonprofits could actually use HUD programs because they actually got cash from the government to pay for the projects that they were running. The tax credits are of no value to nonprofits. Why?
They don't pay tax.
They don't pay tax. I mean, that's one of the cool things about being a nonprofit. You're tax exempt. Of course, nonprofits run a lot of low-income housing projects. So they set up this Rube Goldberg apparatus where they get rich investors to basically launder the money to them, collect a bunch of money. Some of it goes to the project after the investors get their cut, and then the investors get their tax credits back, and everybody's kind of happy. Well, in 2009, the economy tanked, and in particular, financial institutions. Some of the financial institutions that had the biggest investments in low-income housing credits were things like Fannie Mae and Freddie Mac. They weren't doing well. They didn't have a lot of they didn't have any tax liability. Actually, Fannie Mae and Freddie Mac probably will never again have tax liability. They couldn't use tax credits. So Congress said, okay, for 1 year only, we'll give states the authority to turn these things into direct cash outlays. And for 1 year, the $3 billion in tax credits turned into $3 billion in cash grants. Taxes went up by $3 billion, according to the normal counting. Spending went up by $3 billion. Nothing real happened except for a year. The program actually made a little bit more sense. So it raises concerns about efficiency, raises concerns about equity. Equity because, people benefit from these tax subsidies in different ways. Compliance and administration costs. So a lot of these things are open-ended subsidies that taxpayers have a strong incentive to figure out how to take advantage of, and they do. Tax expenditures also raise special issues, so they create opportunities for tax sheltering. There's an issue of timing of payments. So one tax expenditure that Professor Nassau and I actually like is the Earned Income Tax Credit. I'm assuming that you like that one. You have low income tax clinics. It's actually I looked at some statistics for my testimony, and the number of people and number of children in poverty is cut by more than 4 percentage points by the Earned Income Tax Credit. It's very, very effective. But one of the issues with the EITC is that, unlike traditional welfare, you can't get it over the course of the year. And poor people tend to be poor all year round and not just in April. And actually, that's kind of an insuperable problem. I don't know about clinics you've worked in, but when I worked in low-income tax clinics, they said don't tell people about the advanced earned income tax credit because there's a program to sort of give people the credit in advance through their employers. But the problem is low-income people have really volatile incomes, and they don't know till the end of the year how big a credit they're entitled to. And if you gave them the credit in advance and then you overestimated what they were entitled to, they could owe a large amount of money to the IRS, which would be a real problem. So that you can't do that. So a lot of EITC recipients actually like getting the check at the end of the year, and the reason is that it's a kind of savings for them. They can use it to buy a used car or something else that they would not otherwise be able to afford, but timing is an issue. The other thing is that unless the credits are refundable, and the Earned Income Tax Credit is refundable, you get it regardless of whether you have tax liability, low-income families are left out. So most of the tax credits in the code are of absolutely no value to low-income families. When my children were young, I could take a tax credit for child care expenses. For low-income people, that's worthless. They don't have tax liability, and the tax credit doesn't reduce their liability. An important point, when lawyers and economists talk about tax expenditures, it can sound like we're saying that these things are just bad and we should get rid of all of them. That's not true. They're not bad per se, and there are some things that make sense to run through the tax code. The Earned Income Tax Credit, some of the advantages are there's no welfare stigma associated with it. Another one is you don't have to wait in line in a welfare office during working hours in the middle of the week, which for people in this room wouldn't be a problem. You can get away for an hour or two. But if you're working at a minimum wage job, you might get fired for taking off time to go to the welfare office to get food stamps or TANF. Your Earned Income Tax Credit, you go to the clinic on Saturday morning, do your tax return, and you get it. So participation is much higher than it is with traditional welfare programs. But the point that we're making is that tax expenditures have no reason to get privileged status. You should, especially in a time when we've got very limited resources, you should be thinking about the best way to deliver services. In a lot of cases, it's not clear that tax expenditures are the way to do it. This chart just shows the largest tax expenditures. It looks a little bit different from the chart that you would see on the OMB website or on Analytical Perspectives. And the reason is that I made two changes. One is I added the refundable and the non-refundable portions of the Earned Income Tax Credit. When they show tax expenditures, they only show, this is arcane budget details, but reductions in taxes are counted as tax expenditures. The portion over and above the amount you owe is actually treated as a traditional spending program. So for the Earned Income Tax Credit, $52 billion of that, almost $53 billion, is actually the refundable part and is treated as an outlay in the budget. The child tax credit also includes a smaller refundable portion on the order of $20 billion. So I add those in. The other thing is, you talk about tax expenditures, typically you're thinking about income taxes for individuals or corporations, but there are actually tax expenditures all through the tax code. For the largest tax expenditure, the exclusion for employer-sponsored health insurance, that is the fact that when Syracuse University gives your professors nice health insurance, the value of that insurance is not added to our wages and we don't have to pay tax on it. We not only save the income tax that we would owe on that, but we also save the Social Security and Medicare payroll taxes too. And in the case of the health insurance fringe benefit, that's significant. It's $114 billion, according to the Treasury Department. And the total is almost $300 billion. So, one of the things, this is sort of outside the scope of this discussion, but one of the big issues is paying for health care. The government spends a lot of money on health care, and you know about the Medicare and Medicaid parts. But there's also almost $300 billion a year in tax subsidies. There are actually some smaller provisions that also affect healthcare. And when the Affordable Care Act health reform takes effect, there are going to be much, much bigger subsidies run through the tax code. So there's some salient points from this. One is that some of these things are really big. Another one is that these things are really, really popular, which gets to whether we can actually change much about it. When you think about tax reform, you think about just getting rid of tax expenditures. I went to a party once and I said I was working on a paper on the health insurance exclusion, and this is a bunch of liberals who like big government, high taxes, all that stuff. And I said that I thought that this subsidy made no sense as a matter of policy. The subsidy mostly went to high-income people who didn't need help. It encouraged people to spend too much on health care. The people who really did need help weren't getting anything. And I almost got kicked out before dinner. And people love this fringe benefit. Mortgage interest deduction also makes no sense as a matter of policy. There are only a third of households that are even eligible for it because you have to itemize deductions to get it. And people get the biggest benefit are the ones with really high incomes and high tax rates, high tax brackets. And they're also, we would own homes whether or not we got a subsidy from the government. And actually, if we didn't, who cares? People who really need help get nothing from it. 401k plans, there are a lot of people who think this is a good, and pensions, I think that's a good thing because it encourages saving. Some people would even say it shouldn't be counted as a tax expenditure because maybe one of the issues is what is the base against which you measure tax expenditures. The Treasury Department explicitly assumes that the base is an income tax, where all income from all sorts would be taxed. Some people think that we should have a tax system based on spending, in which case capital income wouldn't be included in tax, or savings wouldn't be included in tax. But those are also big. So capital gains, 401ks, pensions are in this sort of controversial category. But the overall amount of tax expenditures is really quite large. So potentially there's a lot of money involved. This chart just shows what happens to the value and the number of tax expenditures over time. And the solid line is the value of tax expenditures. And you might be surprised not to see that sloping steadily upward as more and more subsidies are added in. One thing about the value of tax expenditures is that probably the single most important factor in determining how valuable they are in the aggregate is what marginal tax rates are. In 1986, when the top income tax rate was cut from 50% to 28%, the value of all sorts of deductions, exclusions, exemptions fell by almost half for high income people. Before 1986, if you put $100 into your retirement account, you saved $50 in taxes. 1987, actually 1988 when it was phased in, you saved $28. So the value of the subsidies fell. So that's a little bit less, but these numbers are big. I mean, for the last 30 years, these things have averaged 6% of GDP or more. That's a lot of money. At current levels of GDP, that's $1 trillion a year or more. The dashed line shows the number of tax expenditures, and this is based on just counting the provisions in the Joint Committee on Taxation's book. And this number has grown really dramatically. Between 1996 and 2006, the latest year that the data are available, the number increases from something like 125 in 1996 to 202, more than a 60% increase. So it's certainly true that lawmakers have been doing a lot more legislating through the tax code than they used to do. This chart is a fun one. I actually discovered on the Joint Committee on Taxation's website that they have year by year how many requests they get from congressmen. I think they post that because they want to say to congressmen, here's why we can't answer your request, although they insist that's not the reason. Anyway, I aggregated these by congressional term. And not all of these are revenue estimates, but every time somebody wants a tax bill to be considered by Congress, they need to get the Joint Committee on Taxation, to say how much it will cost. And if they don't get an estimate, it's unlikely to go anywhere. So in 1987, 1988, right after tax reform, there were about 1,500 requests. By 2007, 2008, run up to the 2008 election, 14,000 requests. That's more than a 700% increase over the interval. I actually posted this on my blog, and the title was a graphical illustration of why the tax code is a mess. The problem is there has been this sense that there are more and more constraints on Congress. They can't ask for a lot of new spending programs, but they want to do something. They want to show their constituents that they're feeling their pain. Senator Chuck Schumer has been great at this. He's always advocated for new tax expenditures. One reason why I'm glad I'm not at Treasury anymore. And And increasingly, they're doing it through the tax code. And it is a problem. You get to Congress, you feel like you should be doing something. When it comes to the tax code, probably the best thing they could do if they can't reform it is to do nothing. But that's just, that's not in their nature. Okay. Oh, interesting. Resume slideshow. This chart just shows that tax expenditures are large compared to, this chart shows tax expenditures are large compared to other spending. Mandatory is Social Security, Medicare, Medicaid, and some smaller programs, food stamps. In 2011, mandatory spending was $2.2 trillion. Discretionary spending was $1.4 trillion, about half, a little more than half going to defense, less than half going to everything else, non-defense discretionary. Total income tax expenditures were $1.2 trillion. That number is, there are various reasons why that number is not really accurate, because there are interactions among them. That's not how much you would save if you eliminated them all. But the point is that these things are really, really big. And mostly they're kind of invisible in the way we measure government. This just shows tax expenditures compared to other taxes. And kind of just net individual income taxes, because one way you can think of the income tax and payroll taxes too as, say, $2 trillion of income taxes minus $1 trillion is given away in tax breaks. It's effectively the way it works. So income tax expenditures, $1.2 trillion. Net individual income taxes, the income tax collections in 2011, $1.1 trillion. In other words, half of the income tax revenues, or almost half the income tax revenues, are given away in special preferences or favors. Corporate income tax is a lot smaller. It's also bigger than payroll taxes. Other includes estate taxes and excise taxes. This chart just shows data over time on tax expenditures. That's the blue part at the bottom. Mandatory. These are entitlement programs, the things that are growing fastest because of the aging of baby boomers, rising healthcare costs. Defense. Well, sometimes when you listen to policymakers, they say they really, really want to cut spending, but they would never support a tax increase, so they can't touch tax expenditures. They're going to protect seniors, so they can't really touch mandatory spending. We certainly don't want to weaken our national defense. That's what Barack Obama did. So what you have left is this tiny dwindling sliver, purple. If you actually crunch the numbers, if you wanted to balance the budget just by dealing with non-defense discretionary spending, eventually it doesn't even work. And actually we need some non-defense discretionary spending. We probably still want roads. We might even want to still have a Congress, although that's debatable at times. So in the paper I developed a simple model to try to explain what was going on, and I'm not going to go through the math, in part because I'm out of time, but in part because I don't like to frighten people who haven't studied economics. If you're really interested in it, there's going to be a seminar in a couple of months, so I'm going to talk to public administration students. You're welcome to come. Just let me know. The assumptions of the model are this. One is that voters value spending programs, whether they're delivered as cash outlays or tax expenditures. They dislike taxes and they dislike deficits. But voters can suffer from this fiscal illusion in the sense that they view new tax expenditures as tax cuts. And they don't perceive the full tax burden. They don't fully perceive that it's going to have to be paid back. Whereas spending programs, presumably, they account for the full cost. You can imagine a more nuanced model in which maybe they underestimate spending programs too, or overestimate them. But the point is that tax expenditures are favored relative to cash outlays. So what are the implications? Well, effectively what happens is that the price that people perceive for tax expenditures is lower than the actual price. So you can sort of imagine that you walk into a car dealership and somehow you have these blinders on, and you think that when they say the car costs $20,000, you're telling yourself it's $15,000. And some economic model, you use a lot of mathematics and fancy formulas and all that stuff. So they're more likely to buy the $1,500 car than the $20,000 car. And basically, that's what the model says. So you get too much spending through tax expenditures because voters underestimate the true price. You get a larger government. People think they're getting government at a discount. So they people value government services, and if they don't think they're paying the full price of it, they want more of it. You get higher taxes or bigger deficits. If you raise taxes to offset the cost of tax expenditures, obviously your taxes are higher, even if the net tax burden doesn't change. So if you enact a new $200 billion tax expenditure and you raise tax rates to offset it, by official scoring, that hasn't changed overall revenues. But in fact, taxes are really higher. You're paying a 36% rate instead of a 35% rate or whatever. And this gets into the more complicated model. It might be that tax expenditures become less and less, and direct spending become less and less efficient the more of them you have. Sort of imagining this kind of production possibility frontier, where first you do the things that really make sense to do through the tax code, and then you do things that make less sense, make less sense, make less sense. The cost grows as you shift more from direct spending to tax expenditures. The consequence of that is you have a smaller shift from cash outlays to tax expenditures. And that might sound like good news, but actually it's bad news because there's a huge amount of inefficiency that's built into it. You not only have too much tax expenditures, you're also producing a lot of things that don't make any sense to produce through the tax code, even if you thought they were sort of worth it. And that's the English language version of those graphs in the paper. So I argue that conservatives ought to care about this. People who think the government ought to be smaller ought to care about the fact that we're understating how big it is, and we're probably distorting the process to produce more spending than you would get otherwise. I also think liberals ought to care about this, and that is, we're, with the aging of the baby boomers, rising healthcare costs, we're going to be cutting spending. And right now, roughly half of the Congress is convinced that we can't touch tax expenditures, which means that all the cuts have to come from the direct spending part of the budget. This is one indication of that. We talked about the earned income tax credit, and that is a program that almost entirely benefits lower income people. That's the way it was designed to be. And the refundable credits are all in that category. That 5.5 for people in the bottom quintile, those credits are worth 5.5% of their income. That's what this chart means. For the middle quintile, it's 2.2% of their income. For upper income people, it's nothing. But for all the other tax expenditures, they benefit taxpayers. Half of Americans don't owe income taxes, in part because of these refundable credits. They don't get any benefit from more non-refundable credits or deductions or exclusions. So the benefits of all the rest of the programs are skewed heavily towards high-income people. So overall, the bottom and middle quintiles get about the same benefit from tax expenditures, but the people who get the really big subsidies to share their income are people at the top. My point, I'm not saying that's good or bad, but at a point at which you're scrutinizing every spending program in the budget to figure out what you can afford to pay for and what you can't, it doesn't make any sense to leave out the programs that are disproportionately benefiting the wealthy. But that's what we were doing. So I wrote this paper, liberals and conservatives read it. They all said, oh gosh, we were completely mistaken about this. Let's get together and fix it. Tomorrow, when I talk to Senate Budget Committee, that was the one thing I haven't done yet. Oh, can't believe it did it again. I'm running out of time, so I'm not going to go into this in detail. What we suggest is that you should account for tax expenditures, treating them like spending. And what that means is that revenues really we're understating revenues, we're understating outlays. So these are actually rough order of magnitude right numbers for the budget, if you think of these as trillions. There's $3 trillion in cash revenues. There's another $1 trillion that goes out to tax expenditures, tax breaks, and outlays, if we properly accounted for them, are understated by the same amount. We've got $4 trillion of spending through traditional spending programs, and $1 trillion that's basically administered by the IRS. The net effect on the bottom line, on the deficit, on borrowing from the public doesn't change because we've increased both spending, both outlays and revenues by the same amount, but we're providing a more accurate view of what the government's doing. And this is just how you would account for a change. So what we suggest is that tax expenditures ought to be integrated into the budget process. We should reform the presentation as I just discussed. We should share jurisdiction for tax expenditures by tax and authorizing committees. And this is really important. 1987, when I was on the staff, my boss went to testify about the low-income housing tax credit, which I thought was not the best use of resources. And we made the case in testimony that the money would be far more effectively spent in housing vouchers. You could help 2 or 3 times as many people. And Charlie Rangel, who was a member of the Ways and Means Committee, said, well, that may be all well and good, Mr. Secretary, but this committee has jurisdiction over tax credits, and it doesn't have jurisdiction over vouchers. Gavel goes, we're done. I want them to have jurisdiction over both. I want the spending committees to look at tax expenditures. I want the tax committees to look at spending programs. I'm not exactly sure how we make this work, but in theory, it's a brilliant idea. Tax expenditures will be added to committee allocations. The other question is, can you control these things? So the budget agreement that was signed to prevent one of the government shutdowns a year ago or so said that if we can't make a deal to reduce the debt by a certain amount, that there'd be limits on certain categories of spending. And if the spending exceeded those limits, they would be reduced proportionally in a process called a sequester. So HHS has $1 billion, $10 billion for their voucher program. You say, well, it's actually only going to be $9.5 billion. Live with it. And they would just do that across the board. Tax expenditures are left out. What we suggest is that we could also cap tax expenditures, say that you'd reduce those by the same percentage as direct spending. It's not an across-the-board cut. We're not saying that every program has to be cut by the same amount, but that the tax committees would be instructed to revise current tax law. Right now, these things are on autopilot. Most of them go on forever. They don't have to be reauthorized every year like traditional outlay programs. What we're proposing is that there be an overall budget cap and that the tax committees would say, well, Joint Committee on Taxation told us we're spending $1.1 trillion on these tax expenditures. Our budget is $1.05 trillion. We've got to cut 5%. And they would do that, and they would submit proposals that would have to be voted on. And you could also do this, a lot of things we talk about tax expenditures also apply to the entitlement programs, mandatory programs, Social Security, Medicare, and Medicaid. The enforcement, so suppose, this is actually shocking to think about, and you couldn't imagine it, but suppose Congress actually couldn't live within the limits. You could put in place enforcement. You could have statutory limits. It's a legal limit that said that there would be automatic cuts unless Congress could meet the budgets for tax expenditures and other things. No, I thought I had another slide. The automatic cuts are challenging. One possibility is you could just cut the value of almost all the tax expenditures directly. You could say, okay, the sequester amount is 5% this year. Therefore, instead of taking a full mortgage interest deduction, you take a 95% mortgage interest deduction. If you have $1,000 of interest, you'd include $950 on your tax return. You could do that for a lot of things. There are some things where it would be problematic, like tax-exempt bonds. Would you tell bond investors, well, actually 5% of your interest is taxable this year? That's kind of the conceptually right answer, but it would make tax-exempt bonds even less efficient than they are now, and they're not very efficient already. And there are other possibilities. Martin Feldstein has proposed an overall limit on tax expenditures to 2% of AGI. You could certainly use that as a way to enforce the cap. You could lower the limit to meet a budget target. The Bipartisan Policy Center had a proposal. So there have been proposals. I think actually the sequester in the Bowles-Simpson report would have raised tax rates across the board to deal with the sequester, to deal with an overage on the cap. This would raise more revenue, but the ironic thing is that it would also increase tax expenditures by the same amount, because if you raise rates, tax expenditures are more valuable. There aren't really any simple solutions. Conclusion is the way we treat tax expenditures is one reason the budget's out of control. It leads to bigger, less efficient government, higher taxes, or bigger deficits. And reducing tax expenditures offers one way to raise net tax revenues while cutting marginal tax rates. and promoting economic growth. And that's classic tax reform, which is where I always come back. That's it. I've got time for questions, right?
Right.
Thank you. I thought if I really just segued into the questions, I could forestall the applause.
No such luck.
Thank you. Questions?
Isn't there a mechanism already in the code that you could use if you wanted to limit some of the tax expenditures? I'm thinking of the phase out that some of us get with regard to the value of our deductions.
Yeah, actually, the funny thing about that is that doesn't, for most people, that doesn't actually limit your that doesn't actually limit your deductions. It's an income tax surtax.
Well,
Because, I mean, actually, if you actually do the calculation, that's what makes tax policy really fascinating and also kind of mind-numbing. It's just so complicated. So the rule is that, actually I don't think it's in place now, but in 2009, before it was phased, in 2001, there was this provision. It was actually named after the congressman who came up with it, PEAS. And it was a phase out of itemized deductions. And when your income got above a certain threshold, it was around $100,000 when this was put in place, for every dollar of income you earned above that, you'd lose 3% of your itemized deductions. So if you had $120,000 of income, you'd lose $600. Is that right? Yeah, $600 of itemized deductions. You just reduce your itemized deductions by that amount. That actually doesn't have any effect on the value of the deductions per se. What it does is it's an income tax surcharge that basically is saying that if you earn $1, you're adding $1.03 into your income. Most people's deductions grow with their income. So it does, in some way, it does create a disconnect between your effective marginal tax rate and the value of the deductions, because the deduction's worth $1, whereas $1 of income is taxed at $1.03. But a proposal that would have the effect of limiting deductions is a proposal made by the president to limit the value of itemized deductions to 28% for high income people. And the logic behind that is, it's kind of related to what I was talking about earlier, that high income people get this big subsidy on their mortgages and low income people get a little subsidy or none at all. What the proposal would do, say if you're in the 35% tax bracket, when you deduct mortgage interest, that reduces your taxable income by, dollar for dollar, it reduces your tax by 35% of the amount of your deduction. What this would do is it would say you can only reduce your tax by 28% of the amount of the deduction. It's actually quite expansive. It's not just itemized deductions. It also includes tax-exempt interest. It would include the value of some fringe benefits like employer-sponsored health insurance. The rationale for it is that it would improve equity and reduce the value of tax expenditures and raise some revenue. I don't particularly like it, and the reason is just it's complicated. And I think a better thing to do is just figure out what you want to let people deduct or not, and just do it. The Bipartisan Policy Center, I worked pretty heavily on their tax reform proposal as part of a debt reduction plan. They would have converted mortgage interest deduction into a credit. And so it'd be worth the same amount to somebody earning $1 million as it would be to somebody earning $100,000 for the same dollar amount of mortgage interest. Would have done the same thing for charitable contributions and some other things. That accomplishes the same goal and actually helps lower income people even more. We actually designed the credit in such a way that it was effectively refundable, so low income people would benefit as much as high income people if they could afford a house. And it would be much, much simpler. There's actually a law professor, Lily Batchelder at NYU, tax law, and Fred Goldberg, who was an assistant secretary for tax policy and an IRS commissioner, and Peter Orszag, you probably never heard of because he's not a lawyer, but they came up with this proposal to convert a lot of subsidies into refundable tax credits. And the logic was that these are spending programs. Why would you design a spending program so that Len Burman and Chris Day get a big benefit from it, and the guy who cleans our offices doesn't get anything? It's just fundamentally unfair, inefficient, makes no sense.
Okay, so my question
First of all, what do you think of Mitt Romney's plan to have a 20% rate, tax cut rate on marginal rate? He's going to repeal the alternative minimum tax, and he's going to cut the corporate rate down to 25%. What do you think of that?
I think it's just ducky unless you actually need to pay for the government. The Tax Policy Center estimated the cost of the plan, and I think it's, loses something like $8 trillion over the next 10 years, compared with current law. And there's a funny thing happening in the GOP, which is that basically they're competing for who can give away the most on the tax side. And Romney has said that he would close loopholes to make up for the lost revenue, although it'd be really hard to make up for a 20% rate, and that he's going to cut spending, but he hasn't been explicit about either of those things. And when you talk about closing loopholes, it's fine to talk about that. I mean, it's sort of easy to fall back into that, but the loopholes you're talking about, the big ones, the ones that are big money, that would make up that kind of a rate cut, are health insurance, mortgage interest deduction. He's not going to cut retirement accounts. The Republican base would skewer him. Probably would cut the ITC. Well, that's right. He's not worried about poor people, but this is actually the most important safety net program out there. It actually does more to lift people out of poverty than any of the others. These things are really, really hard to cut. So, somebody asked me a question at lunch of what I thought about Paul Ryan. I completely disagree with Paul Ryan's policy prescription, but I really admire him for laying out what you could do to balance the budget with keeping tax revenues at their historical average, 19%. It's really draconian. Be big cuts in Medicare, huge cuts in Medicaid, cuts in Social Security, cuts in a lot of other items of discretionary spending, but the numbers would work. Romney's numbers don't work.
So it's completely a campaign.
It's fiction, yeah.
Okay, so my second question is, we all know Herman Cain, whatever. Now, what do you think of the plan? What do you think of the
999 is what I think about it.
What do you think of what it represents? Like, why do you think people got attached to that?
I think he was assuming that people were really credulous. Okay, there are two problems with the 999, well, three. One is probably, actually, I think it did actually come close to bringing enough money to pay for the government. Each of the nines is a sales tax. It's just one in different forms. One is a value-added tax, one is a flat tax, which is another name for a value-added tax, and one is a sales tax, which is what a value-added tax is. So if you want a 25% sales tax, which is what he was proposing, propose a 25% sales tax. It would be, I guess that the fact that it didn't have a lot of traction over the long term, I find encouraging, because it really made no sense as policy. It's fine. I mean, it's absolutely makes a lot of sense to talk about a consumption tax as a replacement for the income tax, but you don't need to divide it in three and have three different collection mechanisms. And you really do need to take seriously the distributional concerns. The problem with a flat consumption tax, which was basically what he's proposing, until somebody pointed out that this would really be terrible for Professor Nassau's people, because they spend more than 100% of their income, whereas really rich people spend a tiny fraction of what they earn, is it's hugely regressive. So every other serious plan for a consumption tax has at least some efforts to try to offset the regressivity at the bottom. But even those have a problem, because if you take care of people at the bottom and you're giving a huge tax cut to people at the top, and you want to raise the same amount of revenue, this is a math problem. People in the middle get skewered. So I'm not a fan. I don't think his pizza was good either. Go ahead.
Oh,
Yeah, yes.
Oh, sorry. Well, no, actually, I had a question exactly about the consumption tax, which was, I brought up in class earlier that, I don't know if you remember way back, the New York Times.com had this cool tool where you could balance the deficit and stuff.
Mm-hmm.
And just for fun, I tried to see if I could do it without cutting Social Security and Medicare. And one of the ways that was possible was if you added the consumption tax that really
Yeah.
changes things a lot. And the thing is, like, we have sales taxes in every state, and that, or it's just as unjust, like, across the board, like in the different earning capacity levels. So, I mean, no one's ever been successful in arguing that we can't have that because it's fundamentally unfair. So is there a way that through the same kinds of ways that we balance out across the states, we could do that and, really sort of help the country out?
Well, state tax systems are, for the most part, really regressive. New York is a little bit unusual in that they actually have refundable tax credits that help low-income people, and they've got a very progressive income tax. But overall, state taxes are basically flat. Is a really good question, and there are a whole bunch of issues in a sales tax and a value-added tax together. The states are worried that the value-added tax would undermine their ability to collect their own, to enforce their own sales taxes. I've actually, in a paper for the Virginia Tax Review, I suggested that we should have a value-added tax that's dedicated to paying for health care. And the logic was that we need a way to pay for health care. We don't want health care to crowd out the entire rest of the budget. And that the value-added tax would, having a dedicated tax, kind of like the payroll tax is dedicated to paying for Medicare and so part of Medicare and Social Security now, is having a dedicated tax would actually build a connection between a tax that everybody pays at the grocery store or wherever, and the fastest growing source of spending for the federal government. And furthermore, if you use it to finance expanding access to health insurance to a lot of middle-income people who don't have it, you could do it in a way that when you look at the benefit that it was paying for and the tax together, that'd actually be pretty progressive. One of the things that might seem anomalous is that every other rich country in the world has a value-added tax. And the Europeans have very big value-added taxes. If you've been to Scandinavia, theirs are 25% or more. Now, Scandinavians are not known for their callousness with respect to poor people. So how can that be consistent? They have these giant value-added taxes, and people aren't revolting in the streets. And the answer is that the value-added tax makes possible a very expansive social safety net. And that's actually the reason that conservatives are really leery of a value-added tax, which is that they're concerned that if we had this very powerful source of additional revenue, that government would just explode. My theory is that if you actually earmark the VAT to pay for health care, and you also cut income tax rates to account for the fact that we have this large new source of revenue, that people would actually see a connection between government spending on health care and a very visible tax. And that could actually build support for sensible things to slow down the rate of growth of Medicaid and Medicare and other health care spending. I don't know that I've convinced any conservative. Larry Summers used to joke.
I'm in on that.
Yeah, all my friends are in on it. Mike, Larry Summers used to joke that liberals dislike a VAT because it's regressive and conservatives dislike it because it's a money machine. And when liberals figure out it's a money machine and conservatives figure out it's regressive, that we'll have a deal. Yes.
I was just wondering if you think any form of flat tax could work in the United States?
Look, I mean, mechanically it could work. I mean, the question is whether it's desirable. The concern, again, is just, we have really extreme economic inequality in the United States. It's close. In 2007, it was at the highest level it had been since the eve of the Great Depression. The top 1% of income earners get 20% of all the income in the United States. And even if you don't care about inequality as an issue per se, you might worry about what that means for the stability of a whole capitalist enterprise. If increasingly all the benefits are going to a narrow sliver of the population, eventually there's going to be a populist revolt. And that could take really destructive forms like, closing the border so we don't trade anymore, even crazy things like a gold standard or something like that. So we need to do something about inequality. The income tax actually does something to reduce inequality. The federal income tax, despite its flaws, and it is deeply flawed, is very progressive. The share of tax taken from high-income people is much, much higher than it is from middle-income people and people at the bottom. People at the bottom, on net, get a subsidy through the earned income tax credit and child tax credit, although they pay payroll taxes and other taxes. So I I would be wary of eliminating that unless we can figure out a way to deal with the underlying economic inequality. The ideal thing would be to come up with enlightened policies that would give every kid in America the chance to end up in this classroom someday, and have the prospect of the vast amounts of wealth you'll all earn when you leave Syracuse. It's just not possible. I mean, there's a large amount of inequality, and mobility is limited. That people who grow up with rich parents just have many, many more opportunities than people who grow up with poor parents. Their parents read to them when they're little. They get good, pre-K education. Their parents tell them about the importance of school. They're properly nourished. They don't have to worry about crime and things like that. And when they go out in the job market, they and their friends have got good connections that can help them. The poor people don't have any of those things. So that worries me. Rob.
What do you think is going to happen this fall or after the election with the expiration of the Bush tax cuts?
That's a really good question. And I worried the last time they were extended that there's going to be a lot of pressure on the president to do it again. The interesting thing was he got Congress to agree to an increase in the debt limit that makes it possible to punt this issue until after the election. The question I don't know is whether Mitt Romney or whoever the Republican nominee is will let him do that. There might be a lot of pressure on him to say what it is that he proposes to do and how he's going to get it done. One interesting thing is if he just let the Bush tax cuts expire, our budget situation is much better for the next 20 years. Deficits are actually declining over time. And I think it's a swing of like $4 trillion in revenues over the next 10 years. There's an argument against allowing taxes to go back up at the end of the year, which is that the economy is still going to be fairly weak. The president is probably going to keep on saying what he's been saying, which is that he wants to extend the tax cuts for low and middle income people, but not for high income people. And the Republicans are probably going to say, you're going to kill the job creators and throw us back into recession. And it'd be interesting to see how people respond to it. I wish we could get people on both sides to say, look, our tax code is actually a total mess. Why don't we agree to do as well as current law, in which we actually raise a bunch more revenues, either by big cuts in spending or by a reformed tax code that would raise as much revenue as we would have if the Bush tax cuts hadn't been enacted. And then I wake up and realize that I don't live in that kind of country. And the answer is I have no idea.
If we have one more question? If not, last question.
So day one, Congressman or Senator Burman, what would be your plan to deal with income inequality in the United States?
That is such a hard question. I'm actually learning more about that because I'm teaching a class in social welfare policy this semester. It's not my expertise. I would actually, just given my background, I would fix the income tax. I think the income tax could be made more progressive than it is, and it could be done in a way that doesn't, that actually would be more conducive to economic growth. I like the idea of, actually I would put in place a carbon tax, because that's one kind of tax that actually would be conducive to economic growth. It would give businesses and individuals incentives to conserve, to reduce carbon emissions in whatever way is most cost effective. You could use that to finance tax cuts, rate cuts at the top, and maybe some subsidies for low and middle income people. The economist Edmund Phelps has made a proposal that we should get rid of the minimum wage and replace it with a flat credit on the first X dollars of wages. I think he proposed, 30%, $3 an hour, up to full-time minimum wage earnings. So turn your $7 wage into $10 after the credit, and you could pay that directly through employers if it wasn't phased out. I would invest a whole lot more in early childhood education. I'd actually bring in really smart people and ask them what you can do to fix neighborhoods, to sort of just end this crushing sense of hopelessness that pervades a lot of poor neighborhoods. This feeling that your options are to be in jail or desperately poor. you've got to give low-income people a sense that, first of all, that you've got to give them decent schools, and then the sense that working hard in those decent schools would pay off. I actually went back to I went to school in Philadelphia, in the city of Philadelphia, and the school is not as good as it was when I was there. And I went to talk to a large social science class, and there were these kids sitting in the back of the class paying no attention at all as I'm talking about how budget catastrophe is going to ruin their lives. And then one of them, pops out her wad of chewing gum and raises her hand and says, "Well, Dr. Burman, how much money do you make?" And I said, "Oh, I'm not going to tell you how much money I make, but I'm going to tell you how much we pay new research assistants at the Urban Institute." And this was a while ago, $35,000. And her eyes just popped out. And I thought, I should have told her that like 10 years ago. Study, pay attention. Don't sit in the back of the class. Sit in the front. If you do well, you can get a job at the Urban Institute or some other place where smart BAs find work. If you do really well, you can get a law degree and then make bundles and bundles of money. I mean, the fact is, for a lot of low-income people, the kind of economic security that you're taking for granted, and I know you're worried about the job market, it's not great, and there might be issues, but the kind of economic security that we all take for granted is that they just don't have any concept of it at all. And I really don't want to be senator or congressman or president, but thank you. Because the problem I have is I actually tend to say what I think, which makes me totally unqualified for any public office.
Well, thank you so much.